Do you remember the sound? Not the beeping digital chirp of a modern ATM vestibule, but the specific hush of a 1960s bank lobby, the way your own footsteps on the marble suddenly sounded too loud, the way the air felt cooler and heavier than the street outside, like you had stepped into a courthouse or a cathedral instead of a place that just held your father's paycheck. You remember the weight of the brass door handle, cold and substantial in your hand, and the low murmur of adult voices that never quite rose above a certain register, as if the building itself demanded a hush. That specific, heavy silence is almost entirely gone from American life now. Today, we're going to figure out exactly why it existed in the first place, and exactly why it disappeared. If you are the kind of person who thinks about these vanished textures of American life, the sounds, the smells, the particular weight of a doorknob that does not exist anymore, go ahead and subscribe, because that is exactly what this channel is for. We are not chasing the big anniversaries or the famous events. We are here to remember the America we actually lived through. The ordinary Tuesday afternoons, the errands, the rooms we stood in without knowing we would miss them. Hit like if any of this is already surfacing memories, because that tells us we are doing our job. To understand the 1960s bank, you have to go back further, to the trauma that built it. The modern American bank branch, the one your parents walked into in 1962 or 1965, was engineered almost entirely as a psychological response to the bank failures of the early 1930s. Between 1930 and 1933, roughly 9,000 banks failed in the United States, wiping out the savings of millions of depositors who had trusted institutions that turned out to be built on nothing but paper and confidence. The Banking Act of 1933, which created the Federal Deposit Insurance Corporation, solved the legal and financial problem. It did not solve the emotional one. Americans in the post-war decades still needed to feel, physically, in their bodies, that their money was safe, and that job fell not to Congress but to architects. This is where a very specific building type took over the American streetscape. The freestanding, often windowless at street-level bank branch, frequently built in a style historians now call New Formalism, defined by architects like Minoru Yamasaki, who would later design the World Trade Center, and Edward Durell Stone. These buildings borrowed the vocabulary of ancient temples and courthouses on purpose: thick travertine or limestone cladding, rows of thin, repetitive columns, a raised podium you had to climb a few steps to reach. None of that was decoration. It was a deliberate, architectural argument, built in stone, that said this institution is older, heavier, and more permanent than your fear. You felt that argument the moment you walked in, and every part of what you felt was designed. That marble floor was not just for looks, and it was not just because marble was cheap in the post-war building boom, though it often was, sourced from Vermont or Georgia quarries and shipped by rail. It was there because marble transmits sound in a very particular way, a hard, clean report instead of a muffled thud. And bank designers of the era understood that a floor that made your footsteps audible made you feel watched, made you feel careful, made you behave like you were somewhere important. The hush was not an accident of good manners. It was engineered acoustics. Look up, and you would usually find a ceiling far higher than the room needed to be functional, sometimes 20 or 25 feet, coffered or ribbed in plaster, with recessed lighting fixtures set flush into the surface rather than hanging down. That extra volume of air above your head cost the bank real money in heating and cooling. And yet branch after branch built it anyway, because trade publications for bank architecture in the period, including pieces run in Banking, the Journal of the American Bankers Association, explicitly discussed ceiling height as a tool for conveying institutional gravity. A low ceiling feels like a shop. A high one feels like a bank. Then there was the teller line itself, usually a long run of dark wood or bronze-toned metal, often topped with a security grille of ornamental ironwork, and here is a detail almost nobody remembers correctly. Those grills were rarely there anymore for actual robbery deterrence by the 1960s. Since most serious security by then relied on time delay vaults and silent alarms wired directly to local police, a system that had become standard practice through the 1950s. The visible ironwork survived mostly as theatre, a visual echo of the 1920s bank robbery era, that reassured customers even after the real security had moved elsewhere, hidden in the walls. You would also remember the vault door, because branches loved to display it, often visible through a doorway or even through reinforced glass from the lobby itself. That was not practical. A vault door does not need an audience. It was there because seeing several tons of engineered steel, frequently manufactured by companies like Mosler Safe Company or Diebold, both major suppliers to American banks throughout the mid-century period, gave depositors a literal, physical object to project their trust onto. You could not see your money. You could see the door that protected it, and that substitution did real emotional work. Move deeper into the branch and you would find the platform area, an open floor without teller windows, usually just outside a set of private offices, where a few desks sat in full view of the lobby, each with its own officer, often addressed by title and sometimes literally with a small brass or engraved nameplate. This was where you went to open an account, apply for a car loan, or discuss a mortgage, and it was deliberately positioned in plain sight rather than tucked away, because banking in this era ran on a very specific kind of manufactured intimacy. The loan officer likely knew your father, might have gone to church with him, might have approved his loan on character as much as paperwork. That visible, semi-public negotiation was itself a design choice, meant to reinforce the idea that the bank was not a faceless institution, but a known neighbor with better furniture. Even the drive-up window, which exploded across American banking through the 50s and 60s, carried more calculation than people realize. Banks like Citizens Trust in Georgia and countless regional institutions built freestanding drive-up lanes, using pneumatic tube systems, the same technology used in department store cash rooms, to shuttle deposits and withdrawals back and forth without the customer ever leaving the car. It felt futuristic and convenient, and it was, but it was also a direct response to a real demographic shift, the explosion of suburban car ownership, and the fact that a woman managing household errands with children in the back seat represented a customer type. Banks were actively trying not to lose to the newer, more casual finance companies popping up along commercial strips. But here is the thing people rarely talk about when they get nostalgic for all of this. That entire architectural performance of permanence and trust was also, quietly, a performance of exclusion. The formality of the marble, the vocabulary of columns and vaults, the whole hushed, temple-like atmosphere, worked precisely because it signaled who belonged inside without anyone having to say it out loud. Studies and investigative reporting throughout the 1960s and into the 1970s, culminating in the redlining findings that helped drive the passage of the Home Mortgage Disclosure Act in 1975, and the Community Reinvestment Act in 1977, revealed that this same imposing branch architecture sat inside a lending system that had for decades systematically underserved black neighborhoods and other communities, marked on now notorious residential security maps drawn originally by the Homeowners Loan Corporation in the 1930s. The building said we are trustworthy and permanent. For a lot of American families, what it actually meant was we were never built with you in mind. That is the tension sitting underneath every one of these branches, and it is part of why they eventually had to change, though it was not the only reason, and honestly, it was not even the primary economic driver of their disappearance. The real decline of the classic 1960s bank branch came from a slower, more structural set of forces. The first was simple real estate math. Those freestanding single-story branches on generous lots with marble facades and high ceilings were extraordinarily expensive per square foot of actual transaction space. And as interest rate competition intensified after the deregulation pushed through by the Depository Institutions Deregulation and Monetary Control Act of 1980, banks needed every basis point of margin they could find. A branch built to feel like the Parthenon was not a branch built for efficiency, The second force was automation. The first modern ATM in the United States is generally credited to a chemical bank installation in Rockville Center, New York, in September of 1969, and while adoption was gradual through the 70s, by the 1980s, ATMs had fundamentally changed what a branch needed to be. If a machine in a wall could dispense cash at 2 in the morning, you no longer needed acres of marble lobby to reassure a customer standing in line at 2 in the afternoon. The third, and maybe the most decisive, was interstate banking deregulation, particularly the Regal-Neal Interstate Banking and Branching Efficiency Act of 1994, which allowed banks to consolidate across state lines and triggered a massive wave of mergers. Regional banks with their ornate, individually designed flagship branches got absorbed into national chains that wanted standardized, low-cost, replicable branch designs, the kind you could build identically in Ohio and Arizona for a fraction of the cost, with drop ceilings, carpet tile, and fluorescent lighting instead of coffered plaster and marble. So when you compare then to now, it is worth being honest about both sides of that ledger, because plenty got better. You can deposit a check by photographing it with your phone, something that would have sounded like science fiction, to a teller in 1966. FDIC insurance coverage, which stood at $10,000 per depositor when the system was young, now protects up to $250,000 per depositor per bank, a limit set by the Dodd-Frank Wall Street Reform and Consumer Protection Act in 2010, giving ordinary families dramatically more protection than their parents ever had. Online-only banks, from ING Direct in the early 2000s to Ally Bank later, forced traditional institutions to compete on actual interest rates, instead of architectural grandeur and the redlining practices baked into that old branch system, have been at least legally dismantled, even if their economic aftershocks still show up in wealth gaps, documented by the Federal Reserve's own Survey of Consumer Finances. What we lost, though, was something harder to put a dollar figure on. We lost the forced, unplanned human contact of the platform desk, the loan officer who knew your name, the specific civic weight of a building that told an entire town, wordlessly, that this is where the serious business of your life happens. You do not get that from an app. You get speed instead, and for most people, most of the time, that is a fair trade. But it was a trade, not a pure gain, and it is worth remembering it as one. So tell me specifically, what do you remember? Not banking in general, but your bank, the one on the corner you actually walked into as a kid. What did the teller's counter feel like under your hands? Was there a lollipop jar? A specific smell? A particular officer whose name you still remember decades later? Tell me in the comments, because that detail, the one only you have, is exactly what this channel exists to keep alive.